So welcome to Self-Invested. My name's Lemuel and today we're going to be talking about SIPPs. That's SIPP, which stands for Self-Invested Personal Pension. So before I get into this topic, I just want to say that this video provides an introduction to SIPPs. Before you actually open one, I think it's important for you to do your own research and make sure you're comfortable with the decision that you're making. I'm not a financial advisor. I'm not an expert. I'm just a regular guy trying to educate himself in personal finance and share what he learns along the way. Now that we got that out of the way, what is a SIPP? Well, it's exactly what it says it is. It's a pension that you invest into yourself. You decide how much you contribute, you decide where that money is invested, and you decide when you actually draw down on the pension. You can invest it in the stock market, you can buy shares, you can buy index funds, and you can buy bonds. So why would you open a SIPP? Well, there are three main tax benefits for opening a SIPP. The first is shared with a stocks and shares ISA. For more information about stocks and shares ISA, have a look in the description for my video on that topic. Similar to a stocks and shares ISA, your investment and your money within a SIPP is protected from tax. So any capital gain, which is the growth in value of an asset once you sell it, is protected from capital gains tax. Any dividends you receive from your financial assets within a SIPP are protected from income tax, and any interest you earn on money within a SIPP is also protected from income tax. The second tax benefit, which is unique to a SIPP, you don't get it with a stocks and shares ISA, is that you get tax relief on any money you put into an ISA. So let me give an example to explain this. Say you're a basic rate taxpayer. That means your pay is taxed at 20%, and you receive £100 in income. 20% of that, so £20, would go to the taxman, and you would end up with £80 in your bank account. However, with a SIPP, when you put your money into a SIPP, if you put that £80 into a SIPP, you would get that £20 back from the taxman, which will take your total investment up to £100. And if you're a higher rate taxpayer, this benefit is even more generous because you'd be taxed at 40%. So if you received £100 in income, £40 of that would go to the taxman and you'd only receive £60 in your bank account. But if you were to put it into a SIPP, you only put in £60, you'd get that £40 back from the taxman, taking your total contribution in the SIPP to £100. So the third tax benefit you get with a SIPP is in the case of death or in the situation that you die. Any money, any of your investments in a SIPP, if you die before the age of 75, is passed on to your descendants or your next of kin, your beneficiaries, tax free. So with a stocks and shares ISA, for example, your investments or the money would be sort of passed on to your relatives or whoever you have in your will. But it will be taxed at that, whoever gets the money's income tax rate. However, if you were to die before the age of 75, any investments and any money within a SIPP would be passed on to your descendants, to your next of kin, your wife, your spouse, whoever that is, tax-free. So when can you access your SIPP? Well, currently you have to be 55 before you can access your SIPP. By 2028, you have to be 57. And this age is likely to increase. For somebody in their early 30s like me, it's likely that you're going to have to be in your 60s before you can access your SIPP. But this doesn't mean that you shouldn't open a SIPP or you shouldn't plan for the future, because it's very likely you're not going to be working for the rest of your life. And to have the same level of enjoyment or the same lifestyle that you're having now, when you actually retire, when you stop working, you need to be putting away money while you're able to and while you're actually earning an income. So once you've built up this pot in your pension, how do you actually use it? Well, when you reach an age that you're allowed to access your SIPP, you have three main options for how you can use the money within it. The first option is that you buy an annuity. Now, this is a product that's usually sold by insurance companies, and it guarantees you an income for the rest of your life. In comparison to the amount that it costs, it is low, but it does give you a guaranteed amount every year or every month for the rest of your life. The second option is that you take 25% of your whole pension pot tax-free, and then you draw down the rest whenever you need it, but that will be taxed at your normal income tax rate. So say you had a pension pot of £100,000, you'd be able to take 25% of that tax-free, so that's 25,000 tax-free as a lump sum, and then any money you draw down from the remaining 75,000 will be then taxed at whatever your income tax rate is at the time that you're sort of drawing that money down. The third option is where you just take a lump sum directly anytime you need money from your pension. Now, this is slightly different to the second option I spoke about called drawdown. In this example, say you had £100,000 as your pot, as your pension in your SIPP. When you take money out, say you took 10,000 out, you'd get 25% of that 10,000 tax-free, so you'll get £2,500 tax-free, but then 7,500 would be taxed at whatever your income tax rate is at that time. And then you can draw on it anytime you want, and it would be taxed in the same way. You'd get 25% free, tax-free, and the remaining sum will be taxed at your income tax rate. However, those three options are not mutually exclusive. You can do a combination of one or two. So, for example, with the second example where you draw down sort of 25% tax-free of your overall pot, so you take 25k of your £100,000 pension pot, you can use the remaining £75,000 to buy an annuity. So now I'm going to start talking about who a SIPP is for. Now, I used to think a SIPP was for self-employed people and anyone that didn't have access to a workplace pension, but I don't think that's true. Even if you have access to a workplace pension, I think it's a good idea to sort of put more money away or contribute more towards when you stop working to your retirement than just your sort of pension, especially when you can get tax relief on the money that you put in it and you can grow it at a better rate than you can in the bank account. Having said that, I don't think that a SIPP is an alternative to a workplace pension. The workplace pension is also very generous. With all the sort of tax relief and tax protection you get with a SIPP, you also get your employer contributing money into your workplace pension. So currently, employers have to contribute 3%, a minimum of 3% of your annual salary to your workplace pension. So if you opt out, that means you'll be missing out on additional money at no extra cost to you. So for example, if you were on a salary of 30k a year, your employer would have to contribute a minimum of £900 to your workplace pension. By not opting in to your workplace pension, you're essentially taking a pay cut. You don't get an additional 3%. That only comes with the workplace pension. If you pay in, your employer pays in. So finally, if you want to do more research on SIPPs, about where you can open them, who provides them, or you just want more information about them, I'm going to leave a few links down in the description for this video. The Money Saving Expert website, for example, provides a list of different providers of SIPPs and the different features you get on each of the different platforms. But out of those on the list, I just want to highlight Vanguard because I think they're a very cheap platform and are worth looking into if you're interested in opening a SIPP. Now, they're on the Money Saving Expert website, but they're all the way down at the bottom. And Money Saving Expert doesn't seem to doesn't seem to promote them as one of the better value sort of SIPPs, but I personally think they are one of the better SIPPs available. You need to do your own research to figure out if you agree with me, but I'll definitely look into Vanguard's SIPP if you're interested in opening a SIPP. Now, thank you for watching this video. Please let me know what you thought of it, if there was anything that wasn't clear, if there's anything you want me to do videos on. Do you enjoy videos on investment and SIPPs and pensions and boring topics like that? Or do you want me to talk about how to borrow well, using credit cards, taking out loans, how to pay down debt? Please let me know down in the comments, and don't forget to like, share and subscribe. Thank you. Take care.